Hey everybody, it's Eric Gross with Keller Williams Pinnacle Group. My wife and I are both licensed realtors in the Cincinnati area, and we're also the acquisition and disposition managers for a local flipping company. We've been doing market video updates for probably about 3 to 4 months now with the changes we've seen in the market, and they range anywhere from once a week, once every 2 weeks, and sometimes even more. So the last one we did was actually 2 weeks ago. We were seeing something, just a trend, more inventory, less houses selling, more price reductions, prices coming down nationally, which has continued. The biggest thing though, interest rates. This is gonna have the biggest impact. That's why we've seen the slowdown in housing that we've seen. And just recently over the past 2 weeks, we took a really big jump. They're starting to cool off a little bit, which is a big positive, but we saw 2 weeks ago when I did my last video, we were close to low 6%, 6.25%, sometimes 6.5% if it was really bad credit score, to now high 6%, low 7%, mid 7%. Anybody who's looking to get an investment property, even higher. The other thing we've seen, and this tends to happen when we see a really big increase in the rates, just to get that 7% interest rate, a lot of buyers are having to bring points to the table. Point is 1% of the purchase value. So typically what we're seeing most common is 2 points. If somebody's buying a $200,000 house, it's $4 extra $1,000 they have to bring. That's a part of their closing costs. Now, how does this affect the market? How does this affect investors? How does this affect everybody? Well, for retail buyers, it makes it more expensive to buy, makes you less willing to want to buy. The good thing is prices will probably come down a little bit, but you're locking in 30 years of a really high interest rate. So what we're telling people, our retail clients, is you marry the house. When you find the house you love, you get it, marry it, date the interest rate. It's going to be temporary. Interest rates are going to fluctuate. Sadly, it looks like we're heading towards a recession. When we do hit that recession / in the recession, once we come out of it, the Fed's going to probably go through some quantitative easing. There's going to be more money available. Interest rates will go down. So date the interest rate, plan on getting it refinanced, and then get rid of the landlord. So that's what we tell our retail clients. So for flippers and our retail clients, that's fine. For our landlords, still plenty of people looking to rent. We still have those issues right now. For our investors, everything should be run more conservatively. So our ARVs, we're typically taking 10% to 20% of the ARV. We're just chopping it off. If we have a $300,000 house, I almost always, unless there's a sale within the past week or two, I'm always automatically cutting the ARV. Even if there is a sale in the past week or two, I have to assume by the time that we're done with the flip and get the property listed, interest rates are likely going to be a little bit higher. We're also going into the slower period of the month, at least for Cincinnati, where we're going to see houses sit a little bit longer. So we're having to be more conservative for our investors. Just something to keep in mind until these interest rates go the other way. So biggest thing is going to be, we do see prices coming down. The speculation is that interest rates are probably going to hit closer to 8% by the end of this year. The Fed doesn't plan on doing any rate decreases, at least as of now in 2023. If that is the case, our interest rates are going to stay closer to that 7-8%. It's going to make it more expensive to borrow, and we do see a correction in terms of prices. Doesn't mean this is going to be a 2008 crash. Doesn't mean that there should be mass hysteria. Just means that be conservative. And then for buy and holds, if your numbers shake out, now's probably going to be the best time. You're going to have the least amount of competition. There's more buyers leaving the market. There's more property sitting. If the numbers shake out, I say go for it. Be conservative with the rents for one, because that's going to be something we might see, possibly rents coming down. If we see a recession, a lot of people losing jobs, it could be something we look at. And just being conservative. That's the number one thing we can preach. So that's kind of just a quick overview. We try to do this just so you feel like you're getting it all in. I will say too, just a fun little stat, and there's some other ones included in our weekly newsletter. Fun little stat, home prices went down month to month for the first time since 2011. So our national average dropped. It was just a little bit, wasn't a ton, nothing to be freaked out about, but it's the first time that the national average has actually dropped since 2011. So if you have any more questions, just go ahead and reach out to us. My phone number is 513-907-4271. Love to have a conversation with you, even if it's more in depth If you're wanting to get into real estate investing, if you're interested in the Cincinnati area or the area surrounding, would love to help you. Hope you have a great day. Bye.